There we go. Welcome everybody to our Lunch and Learn model. Today, we are happy to have one of the supporters of Left Field from very early on, and we've really appreciated all the help he's given us, and he's attended our webinars. He was our very first keynote speaker at our first ever live meetup. So he's been a big part of our growth through the years, and we really appreciate having Paul Moore here from Wellings Capital. Paul, welcome to another Lunch and Learn. Appreciate it.
Chad, what a wonderful opportunity to be here. Thank you for having me again.
Well, absolutely. We'll give you all the time we can find because we always enjoy hearing from you for sure. But Paul's here to present a Lunch and Learn today. Just as a reminder, our Lunch and Learns are meant to be educational. A lot of people come to these thinking it's a deal pitch, and Paul is walking through some deal examples. But the intent of this is from the educational side of things. So I always like to call that out when it's a Lunch and Learn as opposed to a deal webinar. But with that, I will, one last thing, housekeeping wise, if you have questions during the presentation, please drop them in the Q&A and we'll go through them with Paul at the end of the presentation. But Paul, all yours, my friend. Once again, thank you for coming on.
You bet, Chad. Hey, welcome everybody. Such an honor to be here with you all again. Did you guys see the multi-housing news about 10 days ago? The headline was preferred equity is pouring into multifamily. The subheadline said the tried and true financing tool is having a resurgence. Yesterday, I spoke to a Manhattan investment analyst, and I'm down here in Lynchburg, Virginia. So Manhattan sounds pretty cool to me, you know, and he's like, he said, pref equity, that's preferred equity. Pref equity is the prettiest girl at the dance right now. So the question I have, the question you might have today is, what is pref equity? I had that question a year ago when we started going down this path, and it wasn't what I thought, and it might be different than what you think as well. How does it benefit sponsors and investors? What are the risks and downsides? Can you get access or not? What else do I need to know? What are even the terms? How do I even understand pref equity? So we're going to cover everything like that in this webinar today, and we'll hopefully have a chance to answer your questions as well. So Wellings Capital, Chad and I are friends, but Wellings Capital is not affiliated with Left Field Investors, and he's not responsible for anything stupid I say. And you can read the rest of this yourself, right? Okay, so speaking of stupid, no, I'm just kidding. This is me. I've written 3 books on real estate, 2 are on commercial real estate. I got 2 more in the hopper. I've talked to you guys about self-storage before. We've talked about all kinds of things. I think we're talking about RV parks next chance I get to be on, but we are a commercial real estate fund. And Wellings Capital, we typically roll out 1 fund at a time. People invest with us, and then we move on to the next fund. That's not necessarily how it's always going to be, but that's what we have been doing now. So I want to tell you about something that happened to me recently. So this is, I know you're probably thinking, Paul must be a photographer. No, I just took this picture with my iPhone. And you're probably thinking, I know Paul's not a photographer. Anyway, seriously, I took this from the 30th floor of a financial tower overlooking the San Francisco Bay recently. I was in the office of Citadel's former COO, and I didn't know much about Citadel since I'm in the real estate realm, but Citadel was rated as America's top all-time performing hedge fund as of December 2022. So this was the COO of Citadel. He left there not that long ago to start his own hedge fund. He's got an $8 billion hedge fund in the Bay Area, and he is an investor with Wellings Capital. He's obviously an influential investor with this, and one of his partners is on our board. And he gave me some really strong advice. In fact, he challenged me on some things, some ways we were thinking, and he did not pull any punches. I was a little nervous, to be honest. He'd already invested a lot of money with us, but still, I'm sitting here in his beautiful office overlooking the bay. And he asked me to explain why we're investing in preferred equity and what our strategy was. So I did. Then he was looking really serious the whole time. And then he said, listen. I'm like, okay, yes, sir. Listen, this is a narrow window of opportunity you have here. He said, you will not have very long to successfully invest in preferred equity. You should go out and get all you can while you can, because this window will not last very long. So, again, I'm listening to this guy. This is our most, I can pretty safely say out of 780 investors, he's our most experienced. And this is what he said. And then his partner, who was on Zoom, said the same thing. And that guy's since joined our board, like I mentioned. So this is, he was basically telling us about the power. He was telling Ben and I about the power of preferred equity. But I added a few words to this slide. The power of preferred equity right now. Why is right now? Why is it so urgent? Am I just being a used car salesman here? No offense against you guys who sell cars. You guys make a lot of money. I love you. But preferred equity is not going to be the opportunity that it is today forever. So let's quickly look at a graphic overview of preferred equity. So everybody knows about debt, right? So we'll call this is an example capital stack. So this bottom 60% is senior debt. And again, that's an example. And then we're used to the common equity. Okay. That's top 25% in this graph. But preferred equity sits in the middle. And it may not be what you thought when you signed up for this webinar. In this example, the common equity is 25%. The senior debt, like I said, 60, and that leaves a gap of 15%. If this operator, was only able to get 60% debt, and they used to get 75 or 80, and they were only able to raise 25% in equity, and they used to be able to raise, let's say 25. They used to be able to fill this up, but now there's this gap. And this is where preferred equity comes in. It's also called gap financing. And a lot of people also think of this gap as filled by mezzanine debt. And mezz debt has some advantages over pref equity. And I think preferred equity has far more advantages over mezzanine debt, again, from my point of view as an investor. Now, you may wonder, is this something you made up, or like, where did this come from? Well, you may not remember this, but I bet some of you will. In September of 2008, when everything was collapsing, I remember how I felt in September 2008. I'll leave it at that. I had a lot of debt, and it was all against real estate, and I was in a lot of, fear, wondering what was going to happen. Warren Buffett doesn't operate in fear or a lot of enjoyment. He has a very steady hand, and he invested $5 billion in Goldman Sachs when it was imploding. And some people were sure that it was going to go out of business. You go back and read the headlines. And in late September 2008, in the middle of this crisis, and a huge crisis for Goldman Sachs, remember Lehman Brothers and Bear Stearns and all that stuff was happening back then. Well, he invested $5 billion in Goldman Sachs, but he didn't invest in common equity, and he didn't invest in debt. He invested in preferred equity. He was able to acquire preferred equity, not common, not debt, and he made a boatload of money from that. And you can go back and read all that. But if Berkshire Hathaway did it, we thought, hey, maybe this is something we should look at. We actually started looking into preferred equity about a year ago. Now, let's talk about why preferred equity is compelling. So it's generally structured for immediate cash flow, but not only immediate cash flow like debt, also future upside. And it often has a shorter hold time because it's pretty expensive for the operator, the syndicator, to close a deal with pref equity. They often want to, buy you out through a refinance or their own capital injection, or potentially even selling the asset. A lot of these preferred equity deals go 2 to 4 years. The payment priority is ahead of common equity. Remember our capital stack we just talked about. The payment priority is ahead of common, and that is a really important deal in times like this where safety is so critical. It's typically got lower downside risk exposure than common equity, though there's no guarantees. Think about it. In this deal, if this asset dropped in value by 25%, the common equity could potentially get wiped out, but the debt and preferred equity would be untouched. Now, of course, we all know deals can drop by, asset values can drop by more than 25%. And so this is not a safeguard. I mean, the asset could be lost and even the debt could get affected. And we all know that. But I'm just pointing out that it's lower downside risk. It still receives depreciation tax benefits. Now, I added this little parenthetical phrase, as negotiated. You may not always see depreciation, but you often do. Unlike debt and like common equity, pref equity has depreciation, which means paper losses and potentially an opportunity for investors to take a loss or at least offset some of their profits. There's a potential to negotiate management control rights in case something goes wrong. So a pref equity funder that comes in might be able to say, hey, if you're not hitting your metrics, or if you're, whatever, your project's not done on time, or if your rents go down, or whatever, you're not hitting your DSCR, we can boot you out and take control. And of course, that's something that we never want to do as a pref equity investor, but it's possible. We may also be able to negotiate a MOIC. That's a multiple on invested capital. It's really multiple on invested equity, to be technical. A floor to potentially increase returns if taken out early. So if we're making, let's say, 16% a year, we're expecting to make 32% in 2 years plus the compounding effect, and they take us out in a year and a half. Well, we can say, look, we want a 32% minimum return. And sometimes that's worth it to the operator to take the pref equity out sooner. Now, I mentioned my friend from the 30th floor of the San Francisco tower. He said that it's compelling, but he got really serious and he said it's compelling right now. So why is it compelling right now? Well, first of all, many lenders have pulled back compared to 14 to 20 months ago, which has drastically increased the demand for preferred equity. A lot of those, that's creating a bigger gap. But also common equity. There's a lot less common equity being raised. You might have noticed that investors aren't so quick to just write a check or wire money because they're a little nervous, and they should be nervous. Coupon rates and total returns and current pay are much higher than in the past. Now, current pay is where it looks like debt. There's no lien, but it looks like debt and so there's negotiated cash flow right out of the gate from day one. And the total returns, which is also known here as the coupon rate, are much higher than in the past. And we're going to get into that in a minute. Well, that minute's now. So right now we're seeing 16 to 18% total coupon rates, which is, again, the total return for a $1 to $7 million check size. But my friends, it's actually better than that. Here's why. Because we can often negotiate that the operator pay the pref equity, pay their payments a year in advance. I'm serious. And so that would look like a reserve. So the pref equity holder might close and invest, let's say, $5 million in a deal. And if they're getting 10% current pay, that's $500,000 in year one in just current pay. That's, in other words, it looks like interest kind of. That can all be put in reserve, and the net effect to the operator is they're only going to get $4.5 million at closing instead of $5 million. That's the net effect. The logistics aren't important. But think about that. Now that 10% current pay can be put in a T-bill. Now, Buffett just announced that there's $157 billion in cash in Berkshire Hathaway right now. He's not hating that so bad as he did 2 years ago when the interest rates were, whatever they were, like under 1%. Now it's what, 4.5, 5.5%. I'm talking about in this generic era. I'm not sure when you're watching this, but with 5% or so to be made off of that 500,000, it's compounding returns even more. And then the upside, again, that there's current pay, and then there's the upside that's compounded as well. And sometimes there's fees and there's points and there's other things that can help the investors return. So now think about it. Higher interest rates depress common equity returns. Not all of them, but a lot of common equity right now, and I'm talking about in real estate, is getting depressed. The projections are much lower than they were, but this is exactly when pref equity returns go higher, because preferred equity returns generally align with interest rates, plus obviously a large risk premium on top of that. Okay, so this is why it's compelling right now. But my friend also said something else. He said, this is not going to last for long. He said it's a limited window of opportunity. Let's look at the limited window. So when interest rates drop, and they're going to, right, someday, they might go up first, but they're going to eventually drop. Banks will resume lending at higher leverage and relaxed terms. When interest rates drop, sponsors who don't need to refinance won't need gap funding as much as they do now. Now, refinance is another thing. It's something we haven't talked about yet, but a lot of pref equity right now is needed because of refinances. When market uncertainty recedes, institutional investment activity and common equity capital raises will increase. And again, this is obvious. There's going to be a lot more money flowing in the common equity. That's the top part of that stack when people aren't as nervous as they are now. Now, here's something to think about. In the 10, 20, 50, $100 million check size, there's a lot of competition. There's a lot of billions of dollars. I've heard a couple $100 billion, right now looking for deals. Well, they're going to be competing, and that's going to drive down the current pay, cash flow, and the total coupon. But in the $1 to $5 million check size, there's not much competition at all. And what that means is that the coupon rates, and those, like I showed you, for example, 15, 16, 17, 18% total coupon, plus those compounding impacts, plus fees, it's a lot higher now than it probably will be. And this window is going to shut. Now, you may think, well, I want to invest in preferred equity. Well, okay, don't hang up on me, because I'm going to tell you more later, but it's probably not really realistic for you to find these deals on your own. By the way, I'm going to take a little time out. I forgot to mention this up front, Chad. Preferred equity is not the preferred return you see in a normal capital stack. I meant to mention that, in a normal waterfall, I mean. So if you're investing with somebody and they say, hey, the pref or the preferred return is 8%, and then there's an 80-20 split above that, that's not this. Preferred equity, you can get that, obviously. You can get that in almost any deal out there. But this preferred equity, these are separately structured deals, and they're extremely difficult for an individual to get into. I can imagine a large family office doing it, but I can't imagine many individuals doing it. But I'm going to tell you that there are ways to do it. In the Q&A, I'll flesh that out even more. Most investors can't get these terms, okay, when you're subscribing to a regular operator deal. And that was the caveat I was making with the timeout. The concentration, most investors don't want or are not able to invest $1 to $5 million in every deal. That would be a concentration risk for most of us. Operators vet pref equity providers to ensure experience. I was on the phone with that guy from Manhattan yesterday, and he's like, we get all kinds of people, groups wanting to invest in pref equity. But I start asking them questions and realize they don't have a lot of experience, and we're not sure they'll get to the closing table. He said that's our number one risk when we source these deals. You also need a significant network to source the deals. In other words, for us, if we were investing in pref equity, and we are, we need a significant number of people feeding us deals, and I'll show you why in a little bit. Due diligence, the team who's doing the due diligence spends weeks or even months studying the operator, the deal, and more. We just walked away from a deal a month ago that we had spent a year and a half getting to know the operator. Obviously not full time, but we had known them. We had made, let's see, 3 of us, if not 4, had made visits to their office and their sites. And we still walked away even after getting to know them that long. It's significant legal complexity to do these deals. It can cost 20, 30,000 or more just to do the legal. And by the way, the operator pays for that, not the investor, typically, at least in this environment, this this wonderful pref equity environment we have right now. And the senior lender must often approve the pref equity partners. And so the Manhattan guy on the phone yesterday said, "Have you done a deal behind Freddie Mac?" No. "Have you done a deal behind Fannie Mae, which is much, much harder?" "Yeah, we've done that." And he says, okay, that checks the biggest box right there. Because if somebody can do a deal behind Fannie Mae with all their clause and conditions and legal requirements, then that's a really good box to check. Okay. So this is why it's really hard to do it on your own. Now, you may be thinking, okay, enough of the education. I want to see a few deals. Well, this is going to be educational as well. And so, like Chad said before, I only know the deals that we've looked at. So I'm going to show you a few deals we've looked at, a few deals we've done. And I just want to be clear that these deals are already done. So it's not like I'm here today trying to pitch you on why you should invest in our deals. These deals are actually part of our ongoing fund. But again, that's not our purpose here today, to be accurate. So pref equity example number 1. So this was a $5 million investment. This is an institutional grade scattered site single family rental portfolio, which is a fancy way of saying single family rentals. It's got over 1,000 units in 3 cities with over 150 million in value. The operator is vertically integrated. The investment is ahead of the common equity, which, remember our capital stack. I'm tempted to go back to it, but hopefully you remember it. So there's 20% of common equity that's shielding the preferred equity. In other words, it's in first loss position, and that's the top of that stack. It's projecting an annual 10% annual cash flow, and it's also throwing off an accrued 5% upside plus a common equity kicker. So it's compounded, and it's also throwing off a common equity kicker, which means as an investor, the investor would get a piece of common equity just for being in the deal. Okay, so this is some of the single family properties in this deal. So they're not all standalone homes, as you can see by these three photos. Here's pref equity example number 2, and this is the Fannie Mae one I mentioned. So this loan is maturing in 2031. It's fixed at 3.7% with 4 years of interest only remaining. Current pay cash flow is only 9%. The other one was 10, but that's all reserved for the first year. So it's actually getting compounded internally by investing in T-bills over that 12 months. It's accruing 8% compounded annually on top of the 9. So 9 plus 8 is obviously 17% total coupon. The MOIC, or the multiple on invested capital floor, which I mentioned 20 minutes ago, is a 1.3x. So that means there's a 30% minimum profit if they cash the investors out early. There's 25% common equity in this deal, and there are forced sale rights in the event of numerous default triggers. What I mean by that is, as an investor, we could go in and say, hey, you guys have missed your debt service coverage ratio 4 months in a row. According to the contract, on the 4th month, we can force you to sell this property. So that's pretty powerful lever to pull, and especially since, remember, there's no lien. So it's unlike debt, there's no lien, but unlike equity, there is, this forced sale provision and other things we love about it. This is preferred equity example number 3. This one is a $5 million investment in multifamily properties. There's 14 multifamily properties that are already performing in a 2-mile radius. This is workforce housing. The sponsor has owned and operated multifamily for a long time. There's 20% sponsor capital in first loss position. Now, did you hear what I said? It's not 20% common equity. It is equity, but it's sponsor capital, meaning that the operator put all his own money into this deal. The company founders, in fact, are brothers, and they have a $300 million net worth, and they're paying us, I know it sounds crazy, but 15% current cash flow with no upside, and a 2.38% one-time origination fee. So the return on investment on this for the investors, I mean, for us, our company as an investor in this case, is 15%. It's compounded internally to get another, let's say 3 or 4% from T-bills. I'm rounding because it's not a full year. And then origination fee of, it might be less than 3, because if you, I just want to be accurate here. So whatever the T-bill is, it'll compound internally. Then there's also an origination fee of 2.38%. So the total return in year 1 on this is 15 plus 2.38, 17.38%, plus whatever T-bill rate is thrown off internally, because that money was reserved up front. Now, you may say, as people have asked me about, you may say, wait a minute, that's too good to be true. What's wrong? Well, this sponsor is actually getting tax abatement from the city and the state. The property taxes are abated because they're doing workforce housing. As a result, these deals are, from what we understand, incredibly profitable. Now, we do net operating income audits to make sure, before we, as part of our due diligence, to make sure they're really getting the money from where they say they are, and they are. So these are incredibly profitable. And these guys, since they're not raising any money from common equity people, they actually, they don't mind paying the 15% cash flow on this. And you've seen this with hard money, right? This is an example of some of their properties. So this is, you can see these are not class, AA, double A, triple A, whatever they are, whatever's out there. These are not class A multifamily properties. Okay. So now let's look at a couple pref equity investments that didn't close. And I'm not going to tell you why they didn't close unless you're interested enough to ask at the end. So Chad, hopefully somebody will ask that question. This is the next pref equity deal number 4. It's $5 million in a mobile home park with 314 lots. I visited there myself. I promise there's proof. There I am. It looks hot there. And it was, because it was in Louisiana. This was the founders owned and operated commercial real estate since 97. That's a long time. The current pay cash flow was 9%. The upside was 6. 9 plus 6 is obviously 15%. There was a total coupon, 2.5% fee at closing, and then another 1.5% at the exit. And there was 30% common equity in first loss position. We spent a long time, and if you're on my email list, you remember the story. We spent a long time. We made, let's see, 1, 2, 3 of us made trips to their headquarters, and that was actually some time ago. Then this deal came up. I went to Louisiana in the heat to see this mobile home park, and you can see that there's a lot of new mobile homes there. This park is fabulous. I would love to own this park, but I don't own parks. But if I did, I would. But we didn't close on it. And again, Q&A. Another deal we passed on, this one we had planned in June 2023. That was the summer, obviously. Don't know when you're hearing this, but $5 million proposed investment, 10% current pay, 8% upside, 18 total. That would have been the best of all these 5 deals I showed you. 20% common equity in first loss position. The MOIC floor was 1.3, which could mean, if they took us out early, a much higher return. per year, that is. Cash flow sweep, management control rights, all kinds of great rights in there. The sponsor invested 11 million of his own money in this portfolio, and he signed a personal guarantee. Well, he would have if it would have closed. He has $40 million net worth. Unfortunately, we passed on this one as well. And I'm telling you that because there is a lot to go through before investing in a deal. This is an example. This is a 6-month look at the deals we looked at, and these were almost all preferred equity. We looked at 247 deals in 6 months. We passed on 242. We only invested in 5 of them, okay? And this is a team of people looking at these. These are NOI audits, background checks, reference checks. Obviously, we didn't do that on most of the 242. They didn't get that far, but you get the point. So you may be saying, Paul, Chad, tell me some of the terms in preferred equity. I'm glad you asked. Here are some of the terms. We got current pay, and of course, that is the debt-like, it's not debt, but debt-like payments that are made on a monthly or quarterly basis. The coupon rate is the total annual return. The current pay reserve, we talked about already, it's negotiated reserves to pay the current pay from cash flow. That means if they're not sufficient from operations, we've already been paid up front. There's a MOIC floor. We talked about that. That's a total minimum return at the end of the investment. Cash flow sweep. You probably know what that is. A cash flow sweep is a provision that forces all cash flow after debt service to go to the preferred equity partner, even if a reserve's in place, until the cash flow is sufficient to cover the current pay cash flow on the pref by itself. Pretty powerful. Equity kicker. And basically that means that the common equity investors, by the way, if that was in place, would not get much, if any, cash flow from the deal. I think they get none, depending on the type of cash flow sweep. The equity kicker, that's a negotiated upside, providing common equity as a bonus. Promote participation. In addition to the preferred equity, sometimes the GP will give us GP ownership as well. Sort of it's like a co-GP arrangement. Recognition rights. This is a formal recognition by the senior lender saying, hey, we know you're there. We know you've got pref equity in the deal. We're not going to foreclose until you've gone through your due process if there's a problem. Major decision control rights, you get the idea. Forced sale provisions, we can force them to sell. Capital improvement holdbacks, we can actually hold back capital improvements like $5,000 per unit for a multifamily until they've actually spent the money. So that's another way to earn a little bit more money in T-bill or from interest. Now, if you want to learn more about pref equity, you can go to wellingscapital.com/blog, and you can look up our preferred equity terms article. That's a blog that I write, and there's on equity terms. There's more to say here. We're going to move on, and I want to talk about something really, really near and dear to my heart. Now, I don't know when you're going to hear this, but it's almost Thanksgiving, which means it's almost Giving Tuesday, Chad. And we're very, I don't know if you all have seen the movie, The Sound of Freedom. The Sound of Freedom movie exposed in a national way the horrors of human trafficking. And Wellings Capital, and I'm asking all you left field investors to consider joining me to fight this problem. Imagine if it was your child. And that's the question they asked in the movie. Did you know if you took the record profits of Apple, General Motors, Nike, and Starbucks, added those together, that's as of 2021 and before, the record profits, added that up, human trafficking, per the US State Department, their total profit was double the profit of those 4 major companies. That's the record profit. This is a huge problem. And the question is, I know the size of the issue now, but how do I get involved? Do I go do a commando raid In Cambodia, I don't know about you, Chad, but I don't think I'm going to do that. I don't think they'd want me. What do I do? Do I send money off to somebody I've never really met or don't really know? We didn't really know what to do about that ourselves. So we came up with a solution. We're doing the same type of due diligence we are on these nonprofits that we have on commercial real estate operators. And by doing that, we've met them in person multiple times. We have spent time with them. We plan to go on a trip to Cambodia and or Belize where they operate. And we want you to know that, get this, they have a 100% charity navigator score. Now, I don't know when you're going to hear this. They may have a 97, 98, 99, 100, because they re-rate them all the time based on their effectiveness with the money. But last I checked, they had a 100% charity navigator score, which is extremely over the top rare. We donated 5% of our internal 2022 profits to AIM. And I put internal in italics because I want you to understand we didn't take a penny from investors. I mean, they can give directly, but we were giving money out of our pockets. Our partner is aimfree.org. You can go to that website to learn more. We have actually raised and donated and affected it's now $485,000 in the past 2 years because one of the folks that gives to AIM just notified me he just donated $100,000 in the last week of September. So how do you get involved? Well, you don't need us. You can just go check them out yourself, aimfree.org. But if you want to give a sizable amount, and I'm just unbelievably thrilled to tell you that I've got a $5,000 and a $25,000 pledge in the last couple of weeks. And I've got more than that, but the $25,000 pledge came this morning. We would recommend that you contact us and consider being part of the match. Now, what I mean by that is we're trying to match dollar for dollar anybody who gives, anybody who donates on Giving Tuesday. That's after Thanksgiving. And if you want to be part of the match, you can just say, hey, Paul, I'll put up $1,000 in matching funds. And then what that means is we just add that to the match total. And then when Giving Tuesday happens, all the individuals will donate and know that their money's doubled up to that certain dollar amount. Okay. So that's how you can get involved. If you want to reach out to us, you can email me if you're interested in human trafficking, or if you have questions about this webinar, you can email me, paul@wellingscapital.com. You can get some free special reports at our /resources. You can learn about pref equity terms at that blog post I mentioned, and you can just go to our website at wellingscapital.com. So, Chad, I hope that all made sense, my friend. What do you think?
I think it, as always, a very educational, informative, and entertaining presentation from our good friend Paul Moore. So
I don't
Paul,
juggle.
you do juggle. It's just not, balls and that chainsaws or anything like that. Good stuff. Really appreciate it. Really appreciate you sharing the great cause that you're behind as well. I never like to de-emphasize that. That's an important thing that you get involved with, and we appreciate you sharing that as well. But now we'll move to Q&A. An interesting topic you brought today to talk about. We did have one question that came in that I'll kind of paraphrase, was around just talking about the types of investors. And I know this isn't kind of our normal multifamily deal that we look at, but there was an accreditation question that came in. Due to the volume, the size of these that you brought up, I'm assuming typically you're seeing accredited onlys, but I didn't know if there's mechanisms for non-accredited investors to potentially, I think of our TribeVest model, but we've got to get to a big threshold for that. But I don't know if you knew of some way for non-accrediteds to get involved in something like this too.
Unfortunately, SEC has handcuffed most operators, and there is no way that I've heard of for non-accredited investors to get involved. And that pains me to say it, because I really wish there was, but the SEC has made it all but impossible for that to work. And so I know that there's, of course, Reg D 506B deals out there. I've just never seen one in pref equity. May want to check with some of the crowdfunding sites to
Mm.
see if they have anything. And of course, TribeVest will be a wonderful option if you're accredited and going in at a lower minimum.
Yeah, yeah. No, thank you for that. I assume that was the case, but just a reminder again, please drop any questions you have in the Q&A and we'll go through it. So one thing I was going to bring up, Paul, is you've walked through this. You showed single family housing as an element in the fund. You showed multifamily, you showed mobile home park. Talk about the asset classes you generally are looking at for this. Do you open a broad spectrum typically in your funds with these to get into that preferred equity mode, or does one asset class tend to lead itself more than another to be available for this? I talk about that process.
Yeah, so we like self-storage, mobile home parks, RV parks, multifamily, especially tax-abated multifamily, industrial parks and outdoor open air shopping centers. Some people call them strip centers. They're sort of high-end strip centers. And then we have that one in the single family portfolio that's like, sort of a commercial grade because it's such a large portfolio. I'll tell you that even though we tried to do a self-storage and we tried to do a mobile home park, almost every deal we see, I mean, maybe 90% are in the realm of multifamily. Now, what I didn't do a good job of on this webinar is talking about a couple different kinds of pref equity. There's pref equity for development, and that's super common, where like a builder, I have a friend who's a developer, and he said, I make so much money, kind of like the guys I mentioned in the multifamily deal.
Right.
I make so much money. I don't care about paying pref equity at 17, 18, even 20%, because I'm able to take a subdivision out of the ground, buy a cheap piece of land, raw land, and then put all the money into the, roads, gutters, sidewalks, infrastructure, sewers, etc. And that, I'm okay with that pref equity. So development's one type, acquisition's another type, and that would be acquiring typically a value add deal where there's some upside to be able to take the pref equity out. But then there's another type, and that would be a rescue capital. Rescue capital might be where someone's coming up on a refinance and they are in trouble, and they don't have the debt service coverage ratio is not working anymore at this higher interest rate, and the common equity investors are mad because they've got, maybe they've had lower distributions or even stop distributions, or they don't want to do a capital call. So that's another type. I just want to be clear, I don't know much about the development side or the rescue side. It's just something we've never ventured into.
Sure. I would assume. I'm sorry, Paul. Go ahead. Sorry.
I just mentioned earlier too that there could be a refinance without being rescue as well, just to be really clear.
That's fair. And thanks for that clarification. I was going to say, forgive me for interrupting you, but I would assume we're seeing more rescue in this economy under these circumstances that we're in than typically you've seen in the past. It might have been just kind of a regular refinance, if you will, but I'm guessing that's maybe on the growth model right now.
Yeah, that's exactly right. There's a lot more rescue, and some people think pref equity is equivalent to rescue capital, and rescue capital is one subset of pref equity.
That's fair. So Carrie wins the door prize because Carrie asked, why didn't you invest in those last two offerings that you showed in your presentation? So can you walk through what your decisioning was around not investing in those last two assets?
Yeah, Carrie, thank you for asking. And you do win the door prize. So this is a mobile home park in Louisiana, and we got way down the road with these guys, and there's just some funny things that happen along the way. So I'm trying to make sure I protect the identity of the operator. There's no way anybody could figure this out from this, but I just want to make sure I don't make anybody, I really, from the bottom of my heart, don't want to make anybody look bad. But there was a lender on the mobile homes in this one. Now, the vast majority of mobile homes are owned by the individuals, the tenants. And that's one of the reasons we love mobile home parks, Carrie. But there are some that were owned by the company. And when they were acquiring this, the lender, let's say it was Fannie Mae or Freddie Mac or something like that, they don't want to lend money on the mobile homes. Well, we were doing pref equity on the park, and the lender was lending on the park. Well, there was another lender doing a chattel loan on the mobile homes that they owned. And that lender, we did a background check on them. And you may think that's a little extreme. I just don't think you can do too much due diligence. And the background check on that lender came up with like some fraudster who had been in jail for financial fraud in real estate. And, pretty serious. So we were like, time out. We don't want to be in this deal if they're in it. So they fixed that. They got somebody else. But just as we were getting toward closing, Carrie, there were just some things that were weird. Not only my shirt in this picture. Oh, the timing didn't work. Shoot, that would have been fun. If I just said that right. Let me try it again. Okay. Chad, let me try it again.
Mm-hmm.
Not only my shirt.
Okay.
But just weird stuff kept coming up. Okay. And so, but it was never a deal killer. Let me tell you what the deal killer was. We wired the money for closing to the closing attorney and just had to button up a few items. And we were hours away. I mean, literally, we thought, okay, by noon, we'll have this signed. They changed the terms of the deal. And we were like, you're kidding. You changed the terms? Yeah, well, we couldn't do it the way we said. We have to change this. That was it. We walked. And I recommend that if anybody ever changes the terms of the deal on you, that, unless they have an incredibly good reason, and there are a few, like, mistakes in the PPM or something, that they had to fix, I wouldn't. And so this one's quite simpler. These folks were amazing. I mean, this guy had $40 million net worth, and 11 of it was tied up in this portfolio. They were just unorganized or disorganized, whatever the word is. And so we just came to the conclusion that this guy was a fabulous one-off or individual operator, but he had not built a team. We're on the phone with his CFO, and his CFO was like, he wasn't able to find the documents. In fact, I know this may sound crazy, but they couldn't find all their appraisals. Like, they had appraisals on a bunch of their properties. And like I said, we do an NOI audit and all that. They weren't even able to get the appraisals on a bunch, not one, but a bunch of properties. They just couldn't find them. And so we're like, we're going to step back and watch these folks, see how they do over the next 5 years, maybe, and see if we want to invest someday, but not now.
No.
Carrie, thank you.
I think those are valid answers, reasons to back out. The next question we had come in, let me know if you're comfortable talking about this to get into details or not, but the question was, what are the top 3 operators you work with and why? So I don't know if you want to get into names or not, if you're comfortable with that, but maybe you can at least speak to your criteria that you look for if you can't give specifics.
Yeah, these are not operators that anybody would have heard of. I mean, it's not like, wonderful folks out there like, some of the folks that come to the left field investor events. These are a little more obscure, but that's not the point. I think the bigger point is, how could you maybe find some of these deals? And I would say that there's companies like Berkadia who do equity. Berkadia not only does debt, they not only arrange debt. Berkadia is a Berkshire Hathaway merger with somebody else years ago, and they provide multifamily debt, but they also have a division that provides equity. And within that division, they have preferred equity, JV equity, and one other type of equity. So Berkadia is, an example of somebody I would go to. I would also go to any, and again, I'm not answering your question directly, but you could also go to a debt and equity broker. And there's a bunch. I mean, I know one in Columbus, Ohio, where Chad is. At least I think you are, Chad.
Yes, I am.
And there are these debt and equity brokers, and they arrange debt and they arrange equity, and now they arrange preferred equity as well. And there's literally hundreds. I mean, there's probably thousands, but we found hundreds and hundreds and hundreds of them in a Google search. And I mentioned early on, you have to have a pretty wide net. Well, we called and emailed and messaged like well over 100 just to get a small handful that responded and are feeding us deals. I don't know if that helps, but that's probably the best way I can answer the question.
That's fair. The biggest thing that jumped out to me related to the different variables that are playing into these kind of deals compared to what I'm used to as a limited partner, looking at a multifamily, looking at a self-storage, and that there's negotiating power there, that you can negotiate terms in many respects, where as a limited partner, I don't get that opportunity. As an investor looking to get into something like this, how do I vet that kind of deal, knowing that there are variables that are going to come into play that maybe aren't, because it's a fund, I'm not sure what you're going to be negotiating on some of these deals. What's that general understanding going into these to get yourself comfortable, whether it's just, hey, I know Paul Moore and Paul does a great job, so I'm giving Paul, $5 million to go do this. How do you see that playing out differently compared to what the LP does? I always like to bring it back to our LP world, knowing that most our community is in that space.
So Chad, are you asking me that if an LP has a chance to invest in pref equity, either through a bigger fund or directly in a deal, how do they decide if it's a good deal?
That's a fair way to put it. Yes, that was much quicker and more efficient than I said.
No, I just want to be 100% sure, because I actually made a mistake. I told you guys earlier on that it was really, really hard for individuals to invest in pref equity. And I said, I would tell you a way you can do so. But my mistake was I forgot to tell you. So there is I mentioned that the person from Manhattan yesterday said, pref equity is the hottest, or he said prettiest girl at the dance. He actually said hottest. I usually don't use that term, but anyway, I've got daughters. Come on. Right. No, seriously. Anyway, he said that. And so there are a growing number of preferred equity funds, and you can find those. One of them is a well-known person at Bigger Pockets. And I'm not talking about me. That would have been a crazy thing to say, but no, seriously, somebody that was on my panel at the Bigger Pockets conference recently has a pref equity fund. Other people do as well, and I don't know who they all are. And so that's to answer the question of how you can get involved personally. You can also, and I don't mean to say this in a tongue-in-cheek, like in a sarcastic way, but if you won the lottery, or if you retired from the NFL, or, if you have a couple million, several million, and you have a family office, or you're part of a family office, that would be a definite way you want to potentially invest in pref equity. Now, all that said, the answer is going to come down to, it's going to come down to really trusting the person putting the deal together. I don't know how else to say it than that, because it's honestly always down to that. I mean, I always talk about Brian Burke's wonderful book, The Hands-Off Investor. And you guys know Brian, and, Brian knows about left field investors. We talked about it recently, you guys, and you can go through that book, but one mistake in one cell, in one spreadsheet, whether it was intentional or accidental, can throw everything off. And so the question is, do you really trust the person who's giving you the information? Have they done the due diligence they should? Have they done the NOI audits? Have they done the criminal checks, the background checks, the reference checks? Have they flown out to the site and looked for problems? Have they really picked a sponsor who has a deep track record, a great team, and a really intense focus on this asset class, is not on this asset class, not others, not a lot of others, I should say. So that's how I would see it, Chad. I don't know. Does that help?
I think that's fair. Yeah, it is trying to get that understanding of, if it boils back down to the typical know, like, and trust, You know, that's kind
Yeah.
of the golden rule of this business anyway. So this isn't going to operate any differently than our other stuff. That's for sure.
It really is. We did a
Mhm.
survey recently. It wasn't an official survey, but the survey basically gave us the same answer that, you know, we invest with who we trust most. One other thing is I mentioned the pref equity funds and investments out there. There's also a thing called sidecars. A sidecar investment would be if somebody had a portfolio of investments, and let's say they didn't want to be overweighted in one deal, like let's say a preferred equity deal, they might do a sidecar opportunity where somebody could say, hey, I don't want to be in your 100 deals. I want to be in that one deal. That would be another way to get access. I just thought of that.
No, that's a good point. I've participated in one of those. They're fantastic.
Oh, you did?
I have, yes.
That's great.
So good. I'll throw out one last time. Any questions? I know we're bumping up against the hour, so we timed this really well, Paul. But
Good.
by all means, if you do have questions, you want to just meet Paul and talk to him more, his information's up here. He's a fantastic guy just to chat with about this industry. He loves it as much as the rest of us do. But please reach out to Paul and connect with him if you get the chance. But,
Wow, thank you, Chad.
yeah, absolutely. Outside of that, I guess we'll call it. And Paul, thank you for your time again today and your wisdom. We appreciate it.
Thank you, Chad. It was really an honor to be here. And whoever's listening, thank you for investing time out of your life to check this out today.
Very good. Thank you. Thank you to everybody that tuned in.